where we were in December of last year and where we are today, oil prices are up from there by 40%. But global demand forecast has been declining every single month for the last 6 months. In my view, oil prices should not be more than $45 or $50 at the most.
That was Oppenheimer's Fidel Gate. He's bearish on oil. Well, my next guest will give you another story. This is Taking Stock on Bloomberg. I'm Pim Fox. Oil falling below $60 a barrel today, just before a late recovery, but it's around $60 a barrel. It's the first time in nearly 2 months that crude has traded so low. So why does my next guest says that he's the most long-term bullish analyst out there for oil? Let's find out. Rob MacKenzie, analyst at FBR Capital Markets, joining us from Arlington, Virginia. So, Rob, welcome. But what makes you so bullish on oil?
Well, Pim, really, I'm predominantly bullish on the oilfield service delivery stocks, the Weatherfords of the world, the Baker Hughes of the world, the Schlumbergers of the world, simply because these stocks have sold off so much from where they were at the peak. We're near a cyclical trough, and just like every cycle we see in these names, spending will pick up again, and as your prior guest said, China's going to start consuming more again. That's going to trickle through as well. Demand for oil looks like it's bottomed and is trending up. This is the time when you buy stocks, not sell them.
Yeah, but Rob, I mean, if we're going to see low oil prices or oil prices that are lower than they have been, doesn't this mean that a lot of the big exploration companies, the integrated companies, they're going to pull production out of the system because they can't make it profitable?
Well, in a static environment, that might make sense. But what we've seen from the service industry and why the earnings for so many of these service companies have fallen so much is simply that they've cut prices, they've given back, in essence, cost to the E&P companies, to the Exxons of the world, to the Saudi Aramcos of the world, such that their economics are now much improved over where they were, say, a year ago. So what was uneconomic, say, at $55, $60 oil a year or 2 years ago is now economic again, given the ratcheting down of the service industry cost structure.
All right. Now, last week you did a bus trip for some investors in Houston. You wanted to explain to them the value of investing in a lot of these oil field service companies. Tell me about what's going on with Baker Hughes. Right. This is we're going to talk about deep water drilling.
Yeah, we hosted a trip to Houston to focus on investors, both E&P companies and service companies, looking at several of the leading players in the deep water, what they're doing and what their leverage is into this next upcycle. And we came away with several meaningful conclusions, but I guess one of the most meaningful data points I managed to dig up through my channel checks was that Baker Hughes has apparently won one of the big contracts coming up, a completions work for Petrobras on their Tupi field. That's something that should be incremental to them by my estimates of probably $100 to $150 million a year over and above their current business in Brazil.
What about the actual drilling technology that Baker Hughes brings to the party? Is that also important?
Always. It's always important because many times this work, particularly the high specification work, in the case of Tupi here, it's as Brazilians call it pre-salt or as many Americans call it sub-salt work, very complicated drilling activities to get down there. And because of their technology, Baker Hughes has greater than 50% market share in directional drilling, in drilling fluids in Brazil, because Petrobras has a confidence in them to get the job done on high-tech work like this.
What is directional drilling, Rob? Can you give us the explanation? Is that like measuring what goes on while you're actually doing the drilling?
It combines measuring what you're doing, yes, absolutely. You have to measure where you are, how the bit's pointed, how fast you're going to steer it. Directional drilling today, the most high-tech way, is what's called rotary steerable drilling, whereby you have a tool at the bit that points the bit or pushes the bit in the direction that you want the drill to go, such that you can create a very clean directional well in almost any direction with few limitations on what you can do with that. It's quite amazing, the technology and how fine a target you can hit these days with directional drilling.
Rob, just talk about the finances for just a minute. Baker Hughes, what about margins right now? How are they going to lift margins?
Well, margins right now for the next quarter or two are going to be under pressure, due predominantly to decline in activity both in North America and certain other areas around the world, like the North Sea, and also the price concessions I mentioned to you earlier, Pim. That's going to impact earnings for the next quarter or two before we start to see a rebound in margins or a rebound in earnings for Baker Hughes. But what I'm taking a step forward and looking at is a year from now, what are these stocks going to be looking at? What are these stocks going to be discounting? And my viewpoint is that 2011 is going to be a very strong growth year for these names. You're going to have continued declines in non-OPEC oil production. You're going to have continued declines in natural gas production around the world, and that's going to lead to a strong rebound in E&P companies spending in 2011. When you look at what these service companies could earn then, and you put a multiple on it and discount it back to present, all of these names, Baker Hughes included, in my viewpoint, have between, say, 40 and 80% upside from here.
All right, we're going to continue the conversation. Coming up, we're going to tell you about a company, if you want to take advantage of drilling in Mexico and Iraq. We've got the company, we've got the analyst, Rob MacKenzie. More coming up right after this. This is Taking Stock on Bloomberg. I'm Pim Fox. I'm joined by an expert in the oil field services industry, Robert MacKenzie. He covers the industry group for FBR Capital Markets. Rob, we talked about Weatherford rather, we talked about Baker Hughes. I want to talk about Weatherford. You say this is one of the best picks that you've got. And tell me about what are they going to do to grow their business? Where's it coming from?
Well, Pim, there's many areas that Weatherford's growing their business from. And it's been my top pick since late last year when the stock was trading below $10. This is a company where the management team has made numerous very savvy decisions, both in the last upcycle and through this down cycle, to position the company for growth. And in fact, just today it passed Halliburton in enterprise value, becoming the second largest, at least publicly traded, oilfield service company in the world on an enterprise value basis.
All right, so sorry, go ahead. I was just going to ask you the geographies. Just give us a little bit of a tour.
Well, examples of what they've done range from several years ago buying some assets from Precision Drilling of Canada, which gave them land rigs in the Middle East, as well as a directional drilling tool, to more recently building on work in Mexico on the giant Chicontepec field there, where they, in essence, captured some share previously held by Schlumberger in work for Pemex. And more recently, they're the only really large cap in E&P service company, with assets and people of meaningful nature on the ground in Iraq, positioning themselves to try and capture some of the billions of dollars of service activity that's going to come over the next several years.
All right, and what about another company, Key Energy? This is a play, on North America, right?
Yes, Key Energy is my favorite early cycle oil leverage play in North America. What they do is fix damaged oil wells and gas wells, but oil wells tend to need a lot more maintenance. The first thing we tend to see operators do when they come out of a cycle is spend money on low risk, high return, low capital intensity projects. And repairing wells that have been broken or damaged or aren't producing what they should be is exactly that. And we've already started to see this activity pick up. We've seen it in some of the numbers from some of their competitors. We've heard it anecdotally from other players. This is the first area the cycle's turning, and the stock is not pricing that in yet. What about Mexican onshore oil? Is that also a plus for Key Energy? That is also a plus for Key Energy, Pim. Key recently expanded into Mexico in a meaningful way last year. Last year they had about $40 million of revenue in Mexico. They're currently at about $120 million annual run rate, with further opportunities to add to that in the next couple of quarters. So we expect that to be a very bright spot for Key Energy in servicing these oil wells. And longer term, specifically on the back of the Chicontepec work that Schlumberger and Weatherford are doing, those wells, after they're drilled, are going to need a ton of maintenance over time. The potential there is quite mind-boggling, actually. All right, I want to thank you very much. Rob MacKenzie, coming in expert in oil field services from FBR Capital Markets, bullish on Weatherford, Key Energy, as well as Baker Hughes.